Hi everyone, welcome to the Fifth Person video training series. My name is Rusmin. I'm the co-founder of the Fifth Person Singapore award-winning investment portal. Right. So in this video, I'm going to share with you 5 important metrics that you need to know if you are planning to invest your money in Singapore or Malaysia REITs. So after watching this video, you can use some of these metrics that you will learn to help you to differentiate between a good REIT and a bad REIT. And you want to invest your money in a good REITs because these are the investments that's going to help you to pay very steady and growing dividends year after year. And at the same time, if you pick the right quality REITs, you get to enjoy a very decent capital gain along the way. Okay, so if you're ready, let's get started. The first metric is property yield. So this is a metric that you use to measure the kind of return that the commercial properties that owned by the REITs itself, how much are they actually generating in terms of yield, right? So if you have proper understanding this statement, let me put it simply, right? So I believe most of us who have owned a property in our lifetime, either through our own names or together with our spouse, or sometimes some of you may invest in a lot of property in Singapore or even in Malaysia, right? So let's say you decided to invest in a residential property, so you decided to lease it out to collect the rental income, and obviously there will be expenses that incur. It could be fixing certain things, it could be wear and tear. Within the year itself, there will be expenses, and you need to minus off the expenses in order to get your net rental income. So this is your actual rental income where you will get in the form of return. And for those of you who invest in property, usually we calculate the net rental yield just to get an idea how much are we getting, when you invest in this property, right? So let's say if you lease it out the property for $60,000 a year, and each year you incur about $10,000 in expenses. And of course, at the end of the day, you minus it off, you're going to get a net rental income of about $50,000, right? And in order for us to know what is the net rental yield for this property, you need to know how much do you pay for this property, or what is the property value at today's market valuation, right? So let's say if you buy this property for a price of $1 million, and this is where you can get a net rental yield of around 5%, right? Simply by taking net rental income divided by property value, right? So 50,000 over 1 million, you're going to get 5% in the form of net rental yield, right? So investing in residential property in Singapore or Malaysia, and in most cases, usually you get 2.5%, and sometimes in good cases, you find opportunities that gives you a net rental yield of around 4%. Okay, so just to give you an idea why net rental yield is important, because you don't want to overpay for that particular property. And if you are getting a net rental income of about 2%, most likely that the property valuations are on the high side. Okay, or the property itself are not generating rental income in order to become efficient. And this is the reason why we look at the net rental yield when we invest in a physical residential property. And likewise, if you look at the commercial property space, like those properties that are owned by the REITs, is very, very similar, right? So the business of REITs is basically to lease out the commercial property. Either it's a shopping mall, it is a hospital, office, or logistic space, right? So this is basically where the REITs manager will be engaged to actually lease out this property to tenants, and they will collect rental income. Instead of calling rental income, they call it gross revenue, because this is a business. So in business, usually we call it sales or revenue, right? And in that year itself, this property obviously is going to incur some property expenses like utility and stuff like that, right? So once you minus it off, you're going to get the net property income. Okay, so let's say the REITs own a pool of properties that lease out a year, and they collect about 100 million in gross revenue. And if that year they actually incur expenses of around 20 million, then you get a net property income of around 18 million. And if these properties are being valued in the market for about 1.6 billion, this is where you can actually get your net property yield. It's also known as property yield, around 5%, right? So in the commercial market, the net rental yield or property yield of 5% is considerably attractive. For a retail REITs, usually is getting around 4.5% to 5%. For office in Singapore or even in Hong Kong, usually the property yield is around 3% to 4%. For light industrial asset, generally the property yield can be a lot higher at 5.5% to 6%. sometimes even more. That's why it's very important to look at property yield, because this will allow us to assess whether the risk manager is generating enough yield for the asset that is actually being tasked to them. Okay, this is not to say that the higher the property yield, the better. Right? Ideally, it is the case, but you need to compare apple to apple, because you can't compare a shopping mall in Singapore versus a shopping mall in Indonesia. You're likely going to get a higher yield in Indonesia because the risks over there are a lot higher. You have forex risk, you have political risk, and there are all sort of risks over there versus Singapore mall, which are a lot more stable and tends to come with a slightly lower yield, right? So when it comes to property, you need to compare apple to apple. So let me give an example of a REIT in Singapore called Fraser Centrepoint Trust. Okay, so this is a REIT that own a few suburban malls that are quite popular. You have Causeway Point, Waterway Point, North Point, Changi City Point, or the Point Mall. Basically, these are the malls, some of the malls that you probably have visited before. Okay, so if you want to calculate the property of Fraser Centrepoint Trust, you can simply go to their annual report and then go to their statements of total return. You'll be able to find net property income under the statements of total return, and you also be able to find the investment property, the value of those investment properties in their balance sheet. Right, so if you look at here, the net property income for Fraser Centrepoint Trust is around 110 million in 2020, and the value of the investment properties is around 2.7 billion. So if you take 110 million divided by 2.7 billion, you're going to get a property of around 4%. Right? And if you go back to 2019, you calculate using the same method, take net property income divided by investment property, you're going to get 4.9%. Right? So if you go back to 2018, 2017, you are likely going to get a property around 5%, 4.8% or 5.2%. Generally, the retail property in Singapore has a property around 5%, right? The reason why there was a drop in 2020 mainly because, if you recall, 2020 is a year where we have COVID-19. All of us were under the lockdown, and because of that, a lot of malls were also being forced to shut. Government actually tell the landlords to give a rental rebate to those tenants that were being forced to close, and because of that, there's actually a fall in terms of net rental income, right? So 2020 should be a year of exceptional year for the retail malls. So it is very important to look at the property yield, and you want to make sure the property yields are healthy and within the market rate. A next metric that you need to know is the cost of debt. So basically, this is to find out how much the interest costs if they borrow money from the bank or the capital market, right? So let me put it simply again. Let's say if you were to invest in residential property and you bought it for 1 million, you're not likely going to pay 1 million in full cash, right? You're going to take advantage of the cheap interest rate that we have in the market. You're going to borrow money from the bank. Let's say you're allowed to borrow up to 80%, right? So you make a down payment of $200,000 and you borrow $800,000 from the bank. And when you borrow that loan from the bank, you need to pay the interest, right? So this is where we need to find out what is the interest rate for the REITs. Okay, so residential property is very simple. The bank will tell you what is the interest rate for the loans that you take up from them. And the same thing for commercial property. So if the REITs manager borrow money from different banks or different instruments that is out there in the market, they need to calculate for you what is the weighted average cost of debt. Okay, so let's say they have a property value of about 1.6 billion, and when the REITs go IPO, they will raise the cash to buy the property. This is where the cash comes in, right? 960 million, and they decided to borrow money from the bank for 640 million, and you need to find out what is the cost of debt for that REIT itself. Okay, the reason why you need to find out is because you need to make sure that the property yield is higher than the cost of debt, because this is where you generate the spread. The higher the spread, the better it is for the REITs manager, so that they can actually pay us increasing dividend year after year if they can make a lot of profit by using others people's money. And if you look at some of the REITs out there in the market, like Parkway Life REITs, which is a hospital REIT, and you have Fraser Centrepoint Trust, which is a retail REIT, and Sabana, which is also an industrial REIT. So all of these REITs have different profile. They have different risk profile. They have a different type of tenants. They have different risk structure, and they will get different type of cost of debt, depending on the profile that they have. Okay, so if you are a Parkway Life REIT, the banks know that you are very stable, you are running a hospital, right, under the long lease structure. They will likely be more comfortable to lend the money to you at a lower cost of debt, right? Whereas if you're in the retail REITs, your leases may be run into those like 2 years, 3 years, relatively short. There's the risk of the tenants moving out, there's a fall of income, and the REITs itself may not be able to pay the interest. Okay, so Fraser Centrepoint Trust has a higher interest rate as compared to Parkway Life REITs. But if you move up the line, you're going to have an industrial REITs, which tends to be a lot more volatile. Sabana, in this case, they are able to borrow money at the average rate of about 3.1%, right? So cost of debt gives you a very good indication whether the REITs has high risk or low risk just by simply looking at the cost of debt. So the whole idea of looking at property yield and cost of debt is because you want to find out the spread, right? So the more spread that you can get from the REITs, right, the more return that you're likely going to receive over time. And the third most important metrics that you need to look at is the gearing ratio, right? So gearing ratio is very important because you want to make sure that the REITs are financially sound, right? You don't want them to collapse in the event when there is a crisis like COVID-19 or 0809 crash. Okay, so let's come back to the residential property market again. So let's say if you buy a property at $1 million, instead of paying down everything in cash, you decided to borrow from the bank about $800,000, right? So in this case, the bank will tell you that, okay, you have a loan to valuation of about 80%. In the case of REITs, right, they are not allowed to borrow so much money, 80%. No, they can't do that because REITs in Singapore and Malaysia are regulated by MAS in Singapore and SC in Malaysia. Right, the gearing ratio usually about 40%, 35%, 45%, and the maximum they can go is going to be 50%, right? Because again, they are regulated, right? So gearing ratio is very, very important because you don't want to be in the situation where the REITs overly leverage, and when the financial crisis takes place, they are not able to pay down the debt on time, or they are not able to refinance those loans that are actually due. Okay, so you want to make sure that REITs are within the regulatory limit and they are not overly leveraged, right? So gearing ratios for some of the REITs that are available in the market out there, for Parkway Life REITs, for example, their gearing ratio is around 38.5%, which is quite conservative, and Fraser Centrepoint Trust is about 35.9%, Sabana, which is a lot lower, 33.5%. Obviously, you're not going to pick a REIT just simply based on gearing ratio alone, because gearing ratio only tell you how conservative they are, and if the gearing ratio started to shoot above 45%, for example, this is the time where the REITs manager may have to reissue capital in order to pay down their debt, because a lot of time when you have a financial crisis take place, the asset value may drop, and that will cause the gearing ratio to go up. That's why I put a 40% so that you have a 10% of buffer over there. And the next metrics that you also want to pay attention is the price to book ratio. Okay, so this is the metrics that we use to value the REITs. A lot of investors actually like to use price to book because it gives them a sense whether the REITs that they're going to buy, is it overvalued or undervalued. Okay, so if you look at these two examples again, I like to bring this because investing in physical residential property is very similar in investing in the commercial property, right? So okay, just that they have different terminology. So in the residential space, if you buy a property for 1 million, you call it as asset, right? You own an asset of 1 million, right? And then if you pay down cash $200,000 and you owe to the bank $800,000, you just simply call it as loan. Okay, but in the book of REITs, for example, right, they call it an asset, 1.6 billion, but they don't call it cash as cash, but they usually call it as equity, because this is the money that unit holders come together and they put into the REITs when it went IPO, or when along the way they may raise capital. At the same time, when they borrow money from the bank, they classify it as liability. So from here, you can find the book value of the REITs through the equity value itself. Okay, so one thing you need to be clear is that residential property, you maybe invest through your own name or through together with the spouse, but when you invest in the REITs, usually you co-own these big gigantic assets together with other unit holders in the market. So how they decided to distribute will be based on shares. So in the REIT space, you don't call it shares, you call it units, right? So now once you have the equity value, you are able to determine the book value so that you can actually have it to calculate the price to book ratio. Okay, so every REITs have their number of units that are outstanding. All right, you can just simply go to their annual report. You'll be able to find the number of units that are outstanding for any particular REITs. So let's assume that the REITs that you're interested have 1 billion outstanding units, right? And how to calculate the book value is very simple. Just take the equity value, which is the net worth, because the loan belongs to the bank, right? So you take total asset minus the loan, you're gonna get your equity value, which is your net worth. And if you take 960 million divided by 1 billion, you're gonna get about 96 cents a share in terms of book value. Okay, so sometimes in REITs we usually call it as net asset value. So this is where you can actually calculate your price to book ratios by simply taking the share price over the book value. Okay, so this is how you can derive your price to book ratio by doing this simple exercise. So let me go through with you how you can actually read the price to book ratio. Usually if you calculate the REITs that you're interested to invest and the price to book comes out to be about 1, we call it as fair valuation, because the net asset value is worth $1 and the price is trading at $1. So this is where you get a fair valuation about $1. Basically, you're paying $1 of value with a price of $1. Okay, so fair value. Okay, so if you calculate and the price to book ratio comes out to be about 0.5, then you are basically getting a discount because you are paying an asset that has net asset value or book value of around $1, but you're only paying for 50 cents. And this is where price to book of less than 1 is considered a discount because you're buying at the discount to the value. And if you calculate the ratio and it comes out to be about 1.3, and this is where we say that it is overvalued because the REITs is valued at $1 and you are paying about $1.30. So this is what we call it as 30% premium. If it's 0.5, we are essentially getting at a 50% discount. Theoretically speaking, this is correct if the value of the REITs is as it is. Okay, but in most circumstances, the net asset value that you're looking here may not necessarily be the value that you get, right, at the end of the day, because the equity numbers highly dependent on the price of the property. So who comes up with the price of the property? It actually comes out by the independent valuer, and they use certain sets of assumptions to come up with this magical number, right? And there's a lot of argument whether the amount can be less or can be more. At the end of the day, when you put up the property on sale, that would be the actual value if there is a willing buyer that is willing to pay for that price. Okay, so you don't want to simply use price to book ratio as a way to help you to decide whether to buy a REIT that is discounted to the value and then sell a REIT that is trading at overvaluation, right? So this is not the way how you should invest in REITs market, because book value is not something that you see and then you can trust the number, right? You should not make your decision based on price to book, right? And of course, the last metric that you need to know is the dividend yield. Okay, so this is the yield that you're gonna get if you invest in the REITs. It's very different from the property yield itself. Property yields are basically the yield that the commercial properties are generating for the REITs, whereas for dividend yield is the kind of yield that you get based on the price that you pay. Okay, so if you can get in the market today a 5% yield, is quite comfortable, right? If you look at the bank, interest rate is less than 1% and you can get a 5% yield for a REIT that is relatively stable, is kind of decent. And if you can find a REIT that is trading at a 3% yield, generally these are the REITs that tends to be a lot safer, like Parkway Life REITs or Keppel DC REITs, which are very popular now because there's a strong demand in data. So if you move up, there are REITs that are trading at a yield of around 8%. These REITs tends to come with higher risks. Okay, so based on distribution yield itself, I also want to warn you that you don't rely blindly on yield and make a decision, because I hear a lot of investors who just entered the REITs market, they started to decide to invest in REITs based on the yield itself. Okay, so you need to analyze the REITs, make sure the REITs have a quality tenants, the properties are located in a good location, and there are a lot of qualitative factors that you need to take into account before you decide to invest in them. Okay, and of course, the metrics that I shared with you in this video is going to help a lot to help you to assess whether a REIT is a good REIT or a bad REIT itself. Okay, so but most importantly, I just want to warn you that you don't simply buy a REIT based on price to book or dividend yield alone. So by now you should have learned a lot of insights about REITs and 5 important metrics to analyze them, and they are property yield, cost of debt, gearing ratio, price to book, and dividend yield. These are the important metrics that I personally use myself, and so far it has worked really well for me. So I hope you can use some of these metrics to help you to find good quality REITs out there so that you can invest in them and make tons of money for yourself, right? And if you're interested to learn more about building passive income through dividend stocks and REITs in Singapore and Malaysia, we have a coaching program where we're going to show you where to find these good dividend stocks and REITs in Singapore and Malaysia, and when is the best time to buy them and sell them, right? So if you're interested in this coaching program, you can check out at the link dividendmachines.com. And before you go, as a bonus for completing this video, I have actually compiled a list of Singapore REITs that have been paying consistent dividends year after year. In fact, they are actually growing. And if you're interested to find out some of these names, you can actually find the download link in the description box below. Alright, so that's all I have for you. And remember, if you enjoyed this video, do give me a thumbs up and share it with a friend. And remember to subscribe to this channel for more video like this in the future. Right, so I hope to see you soon.